Hey, welcome everyone. I'm Don Ross, Ross Wealth Advisors. Thanks for registering for this webinar. Here's what I promise you. It's going to be very valuable and informative information you can make as you're looking to retire, or those of you that are retired, staying retired. Now, here's what's really neat. You didn't have to go out to a restaurant. You didn't have to go to some classroom environment because many of you do not want to do that. However, that's how I've met many of our clients over the years. But you know what? We're in the 21st century. Let's get technology driven. So thank you, and let's get right to it. I would like to back up and share with you a little bit about my first financial decision, or really my first financial lesson. And it goes back like this. It was 1974, and I was about 11 years old, and it was dinner time. And many of you may remember sitting around dinner with all your siblings and your mom and dad. And you know what? I grew up in a very loving household. I had a mother who raised all of us kids. She worked in the home. My dad was a salesman for Bethlehem Steel, now a defunct company. He taught me a lot about really self-awareness and self-guidance, and really, more importantly, self-reliance. Meaning this. So here we are at dinner. I'm a junior hire right here in Central Ohio, and I needed this pair of boots. And Wednesday night was pork chop night, and he's about to take a bite of his pork chop. I said, Dad, I need a new pair of boots. He goes, no problem. Let's go Saturday, because it's the only time you had to go. But he says, how much are these boots, first of all? And I said, well, they're $60. And he said, $60? There's no way. What he taught me was I didn't understand what $60 was. And so he said, if you want more than I can provide for you, son, because I can't buy you these $60 boots, you're going to have to fend for yourself. And basically what I did is that spring I borrowed his lawnmower, nice 21-inch self-propelled Toro lawnmower, and I started cutting this neighbor's yard, that neighbor's yard over here. I would pull the lawnmower behind my bike in the traffic to get to the neighbor 4 blocks down. And I started a lawn care business that I ultimately built into a landscaping company that I sold in 1987 when I entered this industry 31 years ago. But see, my mom taught me even a more valuable lesson about service to others. Here's a woman who journaled every day in her Bible, taught us about faith in God, which is very important to me, and she taught us about service to others. I had the privilege of wearing the uniform of the United States Army as an Army pilot for over 20 years, and I retired in 2007. Many of you sitting out here watching this webinar today served as well. You raised your right hand to include first responders to risk your life for the betterment of others. And that's extremely important to me. So I want to thank you for your service. Some of you were married at the time. And I believe if you were married and not necessarily wearing the uniform, you served just as much. So thank you for your service. Now, my mom passed away 2 years ago from Alzheimer's, and that was the curveball that hit their life in the last few years. And there's going to be curveballs that hit your life, so that's why we need to plan and make sure your estate, your finances, your income plan, and your taxes are set appropriately for this stage of your life, which is some of you are retired and some of you are not retired, but you're getting ready to retire and you're looking for advice out there. And that's why you're here. So let's get started. So here's my intent today. My intent today is to be your educator and your advocator. What do I mean by that? I sit on your side of the table when I'm giving you advice, or we're working on advice together. I'm not being told by my employer, that could be a bank or brokerage firm, what you need. We do that together. So relax, learn, and enjoy, and please pay attention because this is valuable information. How do I know? Because I've tweaked this over the years, and I've had hundreds and hundreds of people attend my workshops, which we're making into this webinar, and say this is one of the best I've been to because it's informative, and that's the whole idea of being an educator as an advisor. Who do we serve? We serve those that are serious. We serve those that want to protect their money. We serve those who are tax conscious, because here's what's important. Many of you have saved very, very well in retirement accounts. And what have you not paid anything of yet? That's right, taxes. And you're going to pay a lot of taxes if you take that money out of those retirement accounts differently than the way that Uncle Sam says you're supposed to take it out. Because Uncle Sam has a very rigid schedule, and many of you know that starts at what age? That's right, 70 and a half. You have to start taking it out. And many of you don't need that money. I also want you to be aware of those we serve are those who have an advisor, but they don't feel like they have a plan in place. Half the people that we bring aboard every year have an advisor, and they don't have a plan in place. And I'm going to teach you about that. What I've created is a team of experts that can help you decide on estate planning, tax strategies, Medicare decisions, Social Security decisions, insurance planning, real estate, funeral pre-planning. All these are on my team. All of these can help you on an independent basis decide what's best for you. I don't employ them. I bring them to the table to make sure if you're making a decision on these areas that you're making the best decision. So we're highly specialized. For instance, see this gentleman? He's a general practitioner. He's a doctor. I think you all could figure that out. But let's say he's my doctor and I need my knee replaced or I need my shoulder replaced. Is he going to do it? Okay, no, of course not. He's going to refer me to a specialist. Folks, that industry of ours, retirement planning, is becoming highly specialized. And if you make a mistake, you don't have what on your side if you make a mistake? Time. So we got to avoid mistakes, so we're highly specialized in these areas. All right, let's get started. We're going to talk about today 3 topics. Now, obviously we do a lot more than this, but this is what I feel will give you the most value in our brief time together in this webinar. To make a good return, we have to risk our money, number 1. Number 2, portfolio costs, overlap, turnover. Most of these things are unknown. Number 3, the 4% rule, income planning and tax planning for 2019 and beyond. Okay, number 1, let's imagine together that you're going to take all of your accounts, your investments, your retirement accounts, 401ks, your bank accounts. We're going to cash it all in, and we're going to take it right here. Who's in? What? You don't want to go here? This is Vegas. You could triple your money. You could quadruple your money. But what else could you do? You could lose it all. Absolutely. My concern is, when I sit down with families every day, is they're doing it right here, Wall Street. Now, I'm not anti-Wall Street. What I have an issue with is many of you, now I'm not talking about maybe you on this webinar, and there's quite a few of you, I'm talking about you retirement-minded across this country that might be investing that's totally inappropriate for this stage of your life, retired or within 5 years of retiring. And you could get hurt. So we're going to talk about how to build the right portfolio as you approach retirement or in retirement. So what is risk? Is it deciding to cross I-70 here in Columbus at rush hour? Is it deciding to skydive without a parachute? Or is it portfolio volatility? Now, folks, this is very important, and I want you to understand this. Portfolio volatility is the roller coaster, okay? And right now, in most of 2018, the markets were pretty volatile. So we have to understand, what does that mean? So on the screen, you're going to see a discussion on volatility. On the first page, you can see 2 portfolios. One at the top is a popular index fund with a very popular fund family. And by the way, it says Sharpe ratio. William Sharpe won a Nobel Prize for understanding how to measure volatility, which I'm going to walk you through, which, again, this is extremely important in this first discussion. The second portfolio is a well-diversified, lower volatile portfolio. Now, look at the returns on both of these. Yes, the popular index fund was 5.67 over a 15-year back testing, okay? The second portfolio has a return of 5.66. Now you might be thinking, okay, big deal. Well, the big deal is when we start putting money to the math, because that'll make a difference. So the next page, you have the same portfolio on the top, but we're going to put $1 million to work. And at the end of 15 years, you can see at the bottom right of the first box, there's 1.85 left. Now the well-diversified, lower volatile portfolio, look what's left in that at the end of 15 years back testing this fund, okay, $2.3 million. Folks, that is volatility. You can see, if you study it, there's smaller losses, but not as big a gain either, though, and that's lower volatility. Okay, you might be thinking, yeah, so what? Now let's look at it when we start taking money out of it, because many of you didn't save to save, you saved so you can enjoy it in retirement, and that's income planning. Even if you don't need the money, but it's in retirement accounts, guess what? You have to start taking it out. So the last page, Let's take a look at this. So the top portfolio, the Popular Index Fund, back tested 15 years. We're taking 50,000 a year out of it. If you look from the second column to the right, withdrawals, look what's left, 363,000. The second portfolio that's globally diversified, lower volatility, we're taking 50 grand a year out. Look what's left of that after 15 years, $1.1 million. So the point of this is understanding volatility. This could derail your retirement. So here's what's important to me, regardless of your volatility. When we sit down together, and again, I'm going to invite you to come in after this webinar, and we'll talk about how that looks. The key is, what do you want to do in retirement? I want to focus on lifestyle things. So maybe you want to educate a grandchild, and you realize, well, I don't have a solid plan in place. So you know what? You have to mark that off. Or you want to buy a second home with your spouse or a family member or a friend. But you know what? You're not really confident in your plan of action. So you know what? We got to scratch that off the list. How about staying retired? You know, we joke about if that Walmart greeter has to be there or wants to be there. Okay, maybe you don't have a solid plan, or maybe you want to travel more in retirement, but you don't have a plan in place that you're confident with, meaning allowing you to spend with confidence. These are the things I want to focus on to make sure you're not missing these topics, or add your own to that list. So here's the thing. Are you investing like them? My point is, this couple to me looks 25 to 32 years old. If you're 55, 60, 65, 70, and you're investing as if you're 25 or 30, you could get hurt like that exercise we just went through. We have to avoid that. What would happen to your nest egg if you lost 30 to 35%? In other words, do you need the markets to really do well for your whole retirement, which could be 20 or 30 plus years? So I want to do a little history lesson here. On this chart, as you can see, it's the Dow Jones since 1896. So if you look at the early 1900s, okay, we had 18 years of kind of flat. Then we had the 1920s, and then we had the stock market crash in 29, and 25 years to get back to even. Then we had the 1950s after World War II. We had some pretty good prosperity. Then we had the 60s and 70s. You know, we had the Vietnam War. We had Nixon took us off the gold standard. And then look at 1980 through 1999. 17 years of the best run-up we've ever had. Why did this happen? In 1974, the latter part of 74, Gerald R. Ford signed into law ERISA, the Employer Retirement Income Security Act. Folks, what was this the beginning of the end of? Pensions. Now, some of you might say, well, I have a police pension, I have PERS, I have STRS. Even those are starting to be restricted more, but more or less I'm talking about some of the private pensions that you might have at Cardinal or Merck or Worthington Industries or any company that offers a pension. A lot of those went away. So what happened in the 1970s and early 80s, as pensions go away, companies say, well, you can put into a 401k. Remember, you could put $2,000 a year into an IRA? Well, here's you and 90 or 100 million other Americans doing what? Putting into the stock market at rates that have never been seen before. And that's why we had such a huge run-up in the 80s and 90s. I don't know what will happen in the future, but we need to make sure you have a plan in place with your investments that will address whatever happens and really is designed for your particular individual needs. The first thing I want to offer you when we sit down is a stress test. I want to look at your portfolio, and we have a software program that can measure what is it costing you in fees that you don't see, what's the risk you're taking that's inappropriate, what income can it generate with consistency and reliability, and so on and so forth. So we must stress test your portfolio first thing right off the bat when we get together, okay? Number two, portfolio costs, fees, taxes, all of that's going on in your portfolio. You know, the Wall Street Journal does articles all the time about the hidden costs of mutual funds. All right, why is that important? Because it's robbing you of return. And you know what? Most people, when they come in, they want to know what they're paying. What are they paying? And most people that come in that have an advisor and they said, hey, I asked my advisor, they don't even know. Well, it's complex, but part of our stress test that I'm offering you, we can uncover that. So let me take you through a scenario. Let's meet Sarah and Tom. Sarah and Tom came to me a number of years back. She was retired at AT&T. Here is the portfolio that they brought to us. They worked with a bank advisor, And you can see here about 18 or 20 different mutual funds, or maybe more. We analyzed for the cost. So you can see about $500,000 in this portfolio, and they're around 2.92% in fees. Now, my stress test can analyze fees more than what you're told you're paying. In other words, Sarah and Tom were told they're paying 1%, which is a usual quote. Heck, I charge 1%. But now we have to manage and understand the portfolios, all those funds that were in there, how much are they costing because of the change and all the trading going on. That's what drives up costs, which robs you of return, which means you might have to take more risk to get the same return. We want to avoid that. So let's talk revenue sharing. So what did we discover with Sarah and Tom? Well, revenue sharing has to do with, there's certain organizations that will sell their funds that have their name on it. And what that means is potential higher compensation to that advisor. Now, it's not illegal, it's not wrong, but what people need to start understanding is, if I'm being sold that fund that might have that bank's name on it or that brokerage firm's name on it, could I be getting unbiased advice? I think no. So revenue sharing is just that. So if you look here, now this was one that we found, it's on Edward Jones' website. Great company, nothing against them, it was just easy to find. And it talks about, if we look at this, revenue sharing payments creates a potential conflict of interest in the form of additional financial incentive and financial benefit to the firm, its financial advisor, and equity owners. If you have funds that might be proprietary that create revenue sharing, you need to know that. Part of my stress test that I talked about in our last section will uncover that, because if you're paying more fees for higher compensation or commissions, you should know that as well. Not illegal, nothing wrong with it, but I think it does create a potential conflict of interest, okay? So we need to make sure we understand that. Great. So when it comes to understanding what is it costing your money to be where it is, what are the fees, what are the unknowns, well, let me put this to you. What do you think a gallon of gas is? You may have just filled up before this webinar, or maybe you're going to fill up tomorrow, but I'm willing to bet all of you on this webinar know what a gallon of gas costs. The next topic with Sarah and Tom were taxes. Now, this is a funny little joke. So during the consultation with Sarah and Tom, I need to look at their tax returns, so they provide them. And you understand the front page of the 1040 has all those little lines on it. Most people don't look at it because they have someone prepare it. Well, I need to look at the taxes for multiple reasons. What taxes could you be overpaying? What are the taxes you're going to pay down the road, pulling out all those dollars out of retirement accounts? And more importantly, what kind of financial products do you have in your retirement accounts? So on the line of your tax return, I asked Sarah in this scenario, Sarah, do you have a retirement account? She goes, yes, we do. I said, tell me about it. She said, well, we have a variable annuity we bought from the bank. Now, I had to conceal the little chill down my spine when I heard variable annuity. Not a big fan of those, okay, because they're kind of expensive products. So we did one of my favorite things. I asked her, Sarah, do you know what you're paying in fees? And she said, no. She said, well, 35 bucks a year. Well, we discovered that's not the case. We discovered when we called the insurance company, these are offered by insurance companies, they're kind of the savings investment products with insurance companies, we discovered she was paying almost 3.5% in fees. That is a lot. Now she's starting to get a little perturbed, understanding that first portfolio went over how much you're paying in fees and risk, and then she discovered this portfolio with the variable annuity, she was paying almost 3.5%, and there was $500,000 in this portfolio. So we needed to fix this quickly. But maybe you're thinking to yourself as you're watching this webinar, hey Don, we have someone doing our taxes. Well, that's great. What I want to look at your tax return for is, what are taxes going to be next year, 2 years, 5 years, 10 years? And as you start pulling money out of your retirement accounts, deferred comps, 403Bs, the police and fire drop funds, I don't care. None of those have been paid tax on. And you're going to start paying tax. So I want to start doing strategic planning now and make sure you're not overpaying taxes today and tomorrow. I mean, right here, this slide demonstrates the huge taxes we're paying just on 4 programs. 4 programs alone. Social Security, Medicare, Medicaid, interest on the national debt. Okay, look at this. 8 cents pays for all these other benefits, and these are just a few of the many. Is the government going to spend less? Are they going to create more revenue? How about, are they going to raise taxes? A lot of people think they are, even under the new tax plan. How about your retirement accounts are going to be a huge tax target, a huge tax target. So we need to have a mitigation, a tax mitigation plan. Very, very important. So whom can you depend on to get the best advice for your situation? Well, certainly not me until I fully understand who you are and what you're trying to accomplish. But let's make sure we understand one thing, that there are proven strategies and techniques out there that are available to everyone. The question is, are you getting the advice that's appropriate for your need? Or the person that's giving you advice, are they aligned with what your needs are? Let me share with you kind of a fun story. I don't know if there's any of you out there that like to visit New York City, but it's a great, great city. I love to visit it every couple of years with my wife. We're kind of boring. We stay in the same hotel. We do the same trip around Central Park, and we go to the same Italian walk down on East 63rd Street. If you're interested in that restaurant, I'll tell you, just send me an email. Anyhow, so this story is about a wealthy man who lives on the island of Manhattan, New York City. And he's about to teach us how to use the rules to his advantage. And this is what I want to teach you. So here's the story. So it's a wealthy man. He drives down to the bank because he's about to take a 2-week trip. He parks out front, walks in, he goes up to the bank manager, says, "Young lady, I'd like to borrow $5,000 for 2 weeks. And the manager, she says, "Well, sure. What do you have for collateral?" He's like, "I got that Rolls Royce parked right out front." Bank manager, she goes, "Fantastic. That is great collateral. Here's your $5,000. Have a great 2-week trip." A few minutes later, after the wealthy man leaves, that bank manager, her manager talks to her and says, "You need to park that car in the safest place. I don't want anybody touching it, looking at it. It has to be protected." 2 weeks later, wealthy man comes back, walks in the bank, goes up to that young, nice manager. "Young lady, here's the $5,000 I borrowed, and what else?" $68 of interest. And she goes, "Thank you very much. But sir, I did a little research while you're gone. I discovered you're worth $20 million. What do you need a $5,000 loan for 2 weeks?" And the wealthy man looks at that young lady and says, "Young lady, we're in the island of Manhattan. Can you park a Rolls Royce for 2 weeks for $68? Right? Now, I assume all of you watching this webinar are chuckling right now because did the guy do anything illegal? No. He used the system to his advantage, understood the rules, and used them to his advantage. Nothing illegal, nothing wrong. This is what I want to teach you that you might be missing, whether you're self-advising or you have someone you've been advising that's been advising you for 20 years or longer. Remember, a lot of the people that end up working with us, and we're selective as are you, sometimes are leaving advisors they've been with it for a long time. But that accumulation advisor is different than a preservation, distribution, tax strategy, income planning advisor like we are. Are you shopping for one of these? Here. Now, what do I mean? I'm using an analogy to help you better understand, are you getting advice that maybe is not appropriate for where you are today? Meaning, if you're out shopping for a Ford F-150 truck, but you walk into a Harley dealership and you're looking for a 4-wheel drive vehicle and you go into a place that sells two-wheeled vehicles, I don't think you're going to get what you need. My point is, you could be getting advice from someone that may not be aligned with what your needs are now. In other words, you could be talking to that Harley dealership salesperson when you really need to be talking to someone in a Ford dealership. Section 3, very, very important. And again, I want to reiterate, if I was to go into all the details, I mean, this could be 3-4 hours long. This is designed to be quick, so you can decide, boy, I need to explore more, and I need to go get my advisor to get on the ball, or I need to come in and see Don. The 4% rule, income planning for 2019 and beyond. So I love using stories of past and existing clients. So here's Joe and Carol. They're 65, 64 years old. Well, we discovered at the beginning of 2008, they had $800,000 invested with their nephew. That's a big chunk of money. Now, the key point is their nephew. He was 4 years in the business. They thought, you know what, we'll give him a shot. They were taking out about $32,000 a year because he was like, the nephew was like, yeah, take out 4% and that'll work. Folks, it doesn't usually work right now unless you have a lot of money and very little expenses. And I'll walk you through that in our income planning. At the end of '08, if you recall, the market dropped a lot. They were at $610,000. They were freaking out. They came in, we did the analysis for fees, portfolio turnover, all these things I want to educate you on that are extremely important. We found out that this portfolio was 90% U.S. large cap stocks. That's one asset class, okay, of 24 that if you're truly diversified, like that volatility exercise we did, they should have never been in that situation. She says we need a new plan. So what do we do first? Like everyone else, we're going to do a Social Security analysis. We're going to have them do a budget. I need to know what you're spending because I want to cash flow that maybe 30 years. Okay, and if we use a 3% inflation rate, that means if you're living on $5,000 now, it's not $5,000 20, 25 years from now. So we have to do that to see if you can sustain that long term. Well, they couldn't have if they stayed where they were. So we had to build them a new plan. So here's what we did for them. Now, a little disclosure, this may not be good for you if we sit down one-on-one and put your plan together, but it sure works for a lot of people. So here's what we did. We took the $610,000 and we set up 4 accounts. Well, 3 of them are designed to generate income that's sustainable and reliable, and the 4th one, the yellow one, is the well-diversified, globally diversified, low-volatile portfolio for what? They need long-term growth. And we even broke that into further little buckets, if you will, because we're going to need long-term growth. So this is called the income maximization management structure, and if we do sit down, we will walk through this to see how it works for you. So what does financial security mean to you? It means different things to different people. It means different things to everyone. So as I'm trying to share as much as I can about who I am as a financial advisor here in Central Ohio, well, let me go one step further and show you what it means to me. Like you, it probably means the same thing. My family. Financial decisions are made based on how it's going to impact these lovely children and my wife of mine. So does your plan include what's important to you? I sure hope so. But let's make sure the intent you have aligns with what your needs are. That's where we see the biggest mistakes. Or do you have a blind spot? And that could provide, in the financial sense, that could provide a problem if you don't see something that's coming down the road or your financial roadmap that could create a real problem. And so we want to make sure we're giving you the perspective that's different than maybe what you see now that could maybe save you headaches or worse. So like Bob and Sarah and Joe and Carol, let's get another set of eyes on your retirement planning. I would like you to schedule your complimentary visit with me today. In a 45-minute strategy session, let's make sure we have a plan that makes sense for this stage of your life. Not yesterday, tomorrow, and moving forward. Here's where we're going to sit. This is where I sit every day with families talking about their goals, their dreams, their wants, their gripes. Basically, in our first visit, here's how it works. I want to answer any questions you have and discuss our philosophy further. Get to know one another, see if we're even a good fit. Okay? We're not changing anything. Or maybe we're going to confirm you're good to go. And then at the end of that first visit, we're going to know whether we need to move on or not. And we'll talk about how I provide my book for you to read and some other small amounts of homework, if you will. I want to give you a heartfelt thank you for attending this webinar, and I really look forward to getting to work on your behalf, which means we sit down one-on-one. But maybe it's not time for you, but either way, thank you very much for attending this webinar. Thank you and have a great day and a blessed week.